Risk management involves identifying, assessing, and mitigating financial risks to protect investments, ensure financial stability, and optimize returns. It is essential for minimizing potential losses and maximizing risk-adjusted returns. Financial risks can be categorized into market risk, credit risk, liquidity risk, and operational risk. Market risk involves losses due to changes in market prices. Credit risk arises from a borrower's failure to meet obligations. Liquidity risk is the inability to quickly trade assets, and operational risk involves losses from internal process failures or external events. Assessing financial risks involves both quantitative and qualitative methods. Quantitative methods use statistical and mathematical models, while qualitative methods rely on expert judgment. Key metrics include value at risk, VAR, which estimates potential loss over a specific time period at a given confidence level. Conditional value at risk, CVAR, which measures expected loss exceeding the VAR, and stress testing, which simulates extreme market conditions to assess potential impact on portfolios. Let's calculate the one-day VOR at a 95% confidence level for a stock portfolio. We load historical stock price data, calculate daily returns, and compute the VAR using the historical simulation method. Visualizing the returns with the VAR highlighted helps understand the potential loss. Hedging involves using financial instruments to offset potential losses in an investment. Common hedging instruments include derivatives such as options, futures, and swaps, insurance policies to cover specific risks, and diversification to spread investments across different assets. The purpose of hedging is to mitigate risk and stabilize returns. Let's use put options to hedge against a potential decline in stock prices. We determine the number of put options needed, calculate the cost of the options, and assess the impact on the portfolio. This example demonstrates how options can provide protection against downside risk. Stress testing evaluates the impact of extreme market conditions on a portfolio, while scenario analysis assesses the impact of specific hypothetical events. These techniques help identify vulnerabilities and prepare for adverse market conditions, ensuring robust risk management strategies. Let's assess the impact of a market crash on a stock portfolio. We load historical stock price data, define a stress scenario, for example 30% market crash, and calculate the potential impact on the portfolio. Visualizing the impact helps understand the potential losses and prepare for adverse market conditions. Continuous monitoring involves regularly reviewing and updating risk assessments. Key metrics such as VR, CVR, beta, and other risk indicators should be tracked. Effective risk reporting communicates risk levels and mitigation strategies to stakeholders. Utilizing risk management software and dashboards enables real-time monitoring and enhances decision-making. Let's create a risk dashboard to monitor key risk metrics. We load historical stock price data, calculate key risk metrics, VR, CVR, beta, and visualize the metrics using a dashboard layout with Dash. This dashboard provides real-time monitoring and enhances risk management decision-making. Risk management involves identifying, assessing, and mitigating financial risks using techniques such as diversification, hedging, stress testing, and continuous monitoring. Key tools and metrics like VAR, CVR, beta, and dashboards are essential for effective risk management. Integrating Python facilitates the calculation, visualization, and real-time monitoring of risk metrics, enhancing decision-making and financial stability.